people in this audience, but I'd like to welcome Bill to the stage to give our keynote speech and kick us off. Thanks, everyone.
Good morning, everybody. Welcome to Banff, June 18th, a couple days away from summer, as you can all tell. I came in on Saturday, so it's been like this since Saturday. So, yeah, it hasn't really changed, but I'm doing the job. Like you couldn't see anything from up the top, but it's clearing up, I hope. So I'm going to talk a little bit about the market, what we've been seeing, what we see from our numbers. I want this to be interactive, though. I hate just listening to the sound of my own voice, so I'm not going to leave time at the end for questions. If you got questions, put your hand up. If you got comments, agree, disagree, feel free to do whatever you want to do. But we're coming from an interesting place from an economy. We've been talking a lot about it, like, maybe because I'm a geek and I like economic stuff, but it is a pretty fascinating time right now in Canada and globally. But the interesting thing, you're going to hear a lot of talk about Bank of Canada, U.S. Federal Reserve. They're all going to pat themselves on the back with this idea of a soft landing. So I was able to raise interest rates, slow the economy, bring inflation down, no recession. That is the gold standard for a central bank person. What that loses, though, is not everybody feels that way. Right? There's a lot of people who do not feel like this is something soft, that there's a lot of financial strain in the marketplace that really gets kind of lost behind those headlines. But we really have seen a great great performance from the Canadian economy. Like, I think we've all expected a recession, pretty much every large bank last year. It's not one of the chief economists sort of summer last year, and he had a recession, and he's like, I don't know, maybe, but I think so. But everyone expected a recession. We just kept moving it every quarter. So every time a good quarter would come in, you would just move it another quarter, but we all expected it. And we're at a point now where it doesn't look like we will. It looks like we will miss a technical recession. And there's a lot of things underpinning that growth. So first off, the job market's been really strong. We would all have expected pretty soft employment growth this year so far. You know, April alone had 90,000 jobs, 20,000 last month, which again was still a pretty decent sized number by Canadian standards. So again, a really strong job market. Unemployment's been rising, but it's 6.2. It's not really high, it's not under control, that's not recessionary levels. So a really good job market has been driving sort of our overall economic growth. So Q1, again, was probably better than anyone would have expected back in Q4. It wasn't quite as strong as people thought because we had a really good January. February wasn't too bad. I think the expectation was we were probably at about 2.5%. It came in much lower, 1.7. But they also revised Q4 way down. So actually, you came off a fairly low point. So the reality was, it's a good number. It's much stronger than we thought it was going to be. And it's sort of been driving that forward. And if you're the Bank of Canada, your challenge is you look at these big aggregate headline numbers. That's what's driving your decision making. And so it's really hard when you see good, strong numbers. Part of the issue really driving this as well is we've actually had really strong disposable income growth. So what people have left in their pocket after their paycheck has actually been growing much, much faster than we've seen from GDP, what we've seen from employment, what we've seen from prices. So income growth has actually really been a core support behind the market right now. We'll talk a little bit about how that, again, is a little bit misleading. The other really big driver and what's really helped us sustain this performance is coming out of COVID, there was massive excess savings. Estimates vary. Our estimate's somewhere around $250 billion. RBC Economics had about $400 billion. But basically a large chunk of money sat in bank accounts because frankly, we weren't allowed to leave the house. We weren't able to go spend it anywhere. It took a while for things to recover. So people were able to sort of stock away a whole bunch of extra money so that as prices went up, they actually had a little bit of a cushion. Now the challenge with that is, if you kind of look at who that was, not everybody had the same advantage here. Not everybody had this excess savings. And what we've been seeing over time is it's been shrinking outside of the top 20% of income holders. That sort of cushion has really shrunk. The bottom 40% never had it. They never had any excess savings. And so again, yes, it was there, but again, the height of the market really benefited from that. So we finally saw the Bank of Canada move last week. It wasn't too surprising, although I personally thought they were going to wait till July. So we actually saw, 25 basis points is really nothing more than a signal to say, hey, we're going to start this process. The good news is really inflation is under control. So 2.7%, not where they want to be. They've got this arbitrary 2% level. I actually was at a thing with Bank Governor Macron was talking, and someone said like, hey, 2%, like, why don't we reconsider 2% and make it like 3% or something? Like, why 2%? And his response was, well, you don't change it just because you can't make it. You know, we said this thing back in 1994. I had hair in 1994. I was skinny in 1994. Things changed, right? So this idea of 2%, I mean, that's just a number that's been picked by them. Their key is that the trend is really moving in the right direction. So at 2.7, they feel comfortable. But if you actually take out mortgage interest costs, which again is driven directly by the fact that they raise interest rates, they're actually below 2%. So if you take out what they're driving, they're actually right where they want to be. So I think they've got the room now. The challenge for the Bank of Canada will really be the US. US economy has been much stronger than Canada, much stronger than they expected. Late last year, Chairman Powell from the US Fed said, oh, we're going to go 5 or 6 times, major decrease in interest rates. And we're in June now, maybe late fall, if he's lucky, he goes 25 basis points. And so the challenge for Canada, if we go too far ahead of them, puts pressure on the Canadian dollar goes down, we import a lot of our stuff, import prices go up, inflation goes up. So he's sort of stuck where he can do so much on his own, but he's really kind of have to pay attention to what the US Fed's doing. The reality is he may not go in the next meeting in July. We actually think it's probably the early September meeting, he'll go another 25 basis points. But he's got the runway right now to do that. The housing market in particular is one I think that people are watching in terms of just sort of consumer behavior and whether they're going to be back in the market. Of course, this happens every time I ever do these presentations. May's number came out yesterday. So May was down a little bit from a sales perspective nationally. So, you know, I think there's a lot of just people waiting. Like if I know the Bank of Canada is going to go down 75 or 100 basis points, why would I lock into something today? And so I think we're at a point in housing where it was rebounding and kind of leveled off with everyone thinking, well, the bank's going to start to lower rates. I'll just wait a little while until that happens. And so, you know, we've seen that kind of come down again. May was a little bit thin, but this is one of the indicators that the Bank of Canada is going to really watch. There is a concern, and I share this concern, at about 50 or 75 basis points, that housing just whipsaws up. That people have a whole bunch of pent-up demand. I've been waiting. 75 basis points is enough for me. I'm going to move in here. And so if that comes back too quickly, then the Bank of Canada likely has to fire the brakes up. So they're going to really watch this number to understand how that happens. Same with house prices. So one of the things that we typically watch is sales to new listings ratio, which is about 52% right now, which is right in the middle of a balanced market. That means prices are pretty stable. And we're down slightly in May, but not by much. So again, their fear is if that starts to accelerate again, that's going to drive inflation. And so housing is going to be a really important bellwether for them about how quickly they're going to move. I think both the US and Canada has been very clear. They're going to move very, very slowly. It's kind of what they do, but they are going to move very, very slowly. So like I said, there's headline numbers that tell us how really strong our economy's been. It's actually been holding the Bank of Canada back a little bit just because it continually surprises them to the upside. But the reality is there's a bunch of stuff behind these numbers that say there are cracks under here. And so especially in a market where you're lending money to people, there's differences, huge differences in performance right now between different segments in the marketplace. And really a big part of this economic story is population growth. The reality is our economy is growing as fast as it is because we're bringing in so many new people. It doesn't mean they're all going to perform at the same level as the average Canadian, but when you bring in so many, your aggregate numbers just go up, right? And the problem for Bank of Canada is we only have so much supply. There's only so many cars available. There's only so many loaves of bread available at one time. So when you bring in more and more people, that's what creates the price pressure. And so that's where our aggregate numbers really been driving from. So last year, 1.25 million-ish people. We talked about it slowing down. Q1 was somewhere around 270,000 new Canadians. And so just a lot of new bodies coming into the market. And what becomes really important from a market, and when you think about lending and think about your businesses and driving volume and growth, is the type of population growth is different in specific markets. Alberta is not being driven by international migration. they're not bringing in lots of new people. Everybody here from Ontario remembers hearing the commercials on the radio the last little while. Come to Calgary, come to Alberta, cheap place to live, come here, great jobs. It worked. It worked really, really well. You probably will not hear those commercials on the radio for the next little while. Because what's happened is, their housing market wasn't ready for that. And the difference becomes, if I'm moving here from Ontario, so Ontario and Quebec, or Ontario and BC were the main sort of in-source to Alberta, I probably already have a car. I'm not coming here to rent an apartment, I'm probably coming here to buy a house because it's so much cheaper. And so the behavior of the interprovincial migration person is very different than the international migrant. You might have very different behavior. So Ontario, BC are really being driven by the fact that it's international people, a lot of international students and temporary workers, puts tons of pressure on the rental market. And so you see that the source of that population growth is very different. In a province like Quebec, for example, they haven't had really great population growth. It's probably one of the lowest in the market. So their economy is much slower. So when you look at your market and who you're sort of selling to, who you're working with, you will see these big variations market by province by province. And when you start to take into account population growth, so I just told you how great our job market was, but the percentage of people in Canada with a job has been plummeting. It's been plummeting for a while. So yes, job growth has been really good. It is not keeping pace with inflation. So about 18 months ago, we had one job opening for every unemployed Canadian. Unheard of. We have never seen that in the Canadian market or the US market. We had 1 million plus job vacancies. We're back down to about 500,000 or 600,000. That's relatively normal now. So again, it started to, but the reality is again, just accounting for population growth, actually we weren't growing. Same with GDP in general. So GDP per capita, lots of conversations about productivity, Canada's decline, blah, blah, blah. What does this all mean? And really, if you kind of look at that chart, like really since the end of 22, so you kind of had the COVID recovery period. And then from that point on, yes, the economy's been growing, but it hasn't kept up pace with population. So again, when you think about people, it seems like, oh my goodness, everyone's out there spending and going wild. It really isn't, right? It's just we have so many more people doing that. The other thing that's really facing the marketplace right now is, not surprisingly, debt payments are much, much higher. You know, particularly in the mortgage market, a lot of that payment is actually going to interest now, not actually paying principal down, and so people are accumulating balances faster. So getting the balance sheet for a person or a household really been sort of impacted. Debt service ratio now is at a record level, driven again mainly by mortgage. So we've seen this sort of hit to people's cash flow and their sort of income stream. So yeah, we've had great growth in income. Again, not uniform. The high end of the market's growing really well. But you know, you've got this situation where now I've got much higher monthly payments, or if I'm not making bigger monthly payments, I'm not paying down my debt at all. But the reality is we actually haven't seen the actual impact of interest rates yet. So the very lucky thing from a Bank of Canada perspective was the renewal process for the last 2 years is coming in the post-mortgage stress test era, so 2018, 2019, where we saw a big drop in mortgage volume. So mortgage volume went way down as people adjusted to the stress test. So that smaller group of mortgages have been renewing lately. So they're actually not as hurt by the fact that rates have changed. And on top of that, interest rates were much higher for 2018, 2019, so they didn't see as wide a difference. What we are going to see is much bigger balances, much higher loan to values, who are going to start to renew now. We're going to have all these variable rates, so going into the higher interest rates, about a third of mortgages are actually variable rate. Most of those, about 75%, do not adjust payments because of the interest rate change. It just pays down less balance. And so you saw this swing that has not really hit the market. And those people renewing, particularly 25 and 26, many of those will have interest rates below 2% on their mortgage. So the really, really big impact. So if the Bank of Canada moves very, very slowly, it is going to really impact renewals much more significantly going through 25 and into 26. And so the real impact of higher interest rates hasn't really hit the market. So again, aggregate numbers are great, but as you think about your market and how you either want to grow or how you want to manage your risk strategies, understanding that there's these segments underlying it, and particularly those people who are going to be exposed to higher interest rates, will become more important as we go along. So what does this all mean for credit in general? In general, it's slowing down, but it's primarily on the mortgage side. You know, for many groups, saying 3% growth would not be slow growth, but for mortgages, That is way below what we saw sort of pre-COVID. So mortgages are slowing. Non-mortgage has been doing okay, kind of just under the 5% growth. But the challenge for that is where is it all coming from? And so we talked about population growth. So when we looked at 23 growth, the majority of the 23 growth was actually coming from people who were either brand new to credit or less than a year. So that's your immigration flow. So people came in, either people aged into needing credit or needed more credit, but more importantly, new immigrants came in. So we saw this surge in new people to credit, which many of you know is much more hard, much more challenging to do. No scores, we have less information. They weren't using more credit, actually, they were using less credit because, again, some were temporary, international students just needed some help. But now what we've seen is it's sliding in, so as we're sort of slowing down that population flow, we're starting to see it sort of move forward. But it's relatively new to credit. It's really been driving this growth in the last little while. So what that means is, where is that coming from? That means it's credit cards. So credit cards is the one area, one source of really, really strong credit growth right now. This is sort of new account openings. So, the red bar on the left there is credit cards. You can see it's slowed down, but still at very, very high level. So again, first credit product for most people, going to be a credit card. And when we see the growth happening, despite the strong growth, the growth is actually happening at the very low end. So again, a lot of that's the new to credit, don't have a credit score, the credit score is very low because they're brand new. But you see, even in the credit card space, it's coming from this population flow. And so when we kind of look across, auto finance, which doesn't include sort of bank lending for auto, it's been okay. It's about 6% growth. Not too bad. It's really recovering. It hasn't really come back as quickly as we thought it would. But you kind of see credit cards is growing at 15%. So again, people are turning to the credit card more often, starting to pay their balance off a little bit slower. Lines of credit have been relatively flat, so it shows up there. That's primarily unsecured lending. But kind of home equity lines, and we're going to talk about why home equity lines are sort of a little bit slower. But this is really about, again, people going to that first credit product and being credit cards. So we have talked about this. So there is some things underneath the market that are telling us that the consumers are starting to hit a breaking point, at least a large portion of them. So we see credit cards are growing fast, 15% growth in balances. A lot of that's just from higher spend. But that higher spend actually is just them dealing with inflation. So when we factor in inflation, credit card spend has been relatively flat. So people are just trying to adjust to a higher cost of living by using that card more. A lot of them, just they want their points. Canadians love our loyalty points still. But some of it is, this is my way of coping from a cash flow perspective. And so we've seen that credit card behavior change. And, bad news for credit card companies, payment rates are still relatively high in Canada. So coming out of COVID, we had all that excess funds, all the excess savings. So the payment rates on credit cards were very high, which is bad news if you're trying to drive interest income in a credit card. But we're starting to see a slight shift. And as it slides sort of go, you kind of understand that what people are starting to do, and we'll show why this is important in understanding your customer, is people are making decisions. And so I'm going to pay my mortgage, I'm going to pay my car loan, I'm going to pay less on my credit card this month. So I'm not delinquent, I'm making a payment, but I used to pay in full every month. I'm not going to pay in full every month anymore. And that becomes a slope, right? If I can't pay full this month, my balance grows, I don't pay next month, and so you continually go down that payment curve. So it's been relatively stable, but we're starting to see the tipping point and that shift downwards. But again, even if you kind of look at the other chart, that's the growth in balances. Look where the balance growth is happening, again, at the lower end of the market. So again, you saw the spend going up, dealing with cost of living. A lot of the balance growth is really coming from higher risk people who are using their credit cards as a bit of a cash flow tool. And so what does that really mean? And so if you kind of look at who's impacted by interest rates, so credit cards, fixed rate, not a big deal. Auto loans, generally fixed rate, not a big deal. Lines of credit are the big drivers. So they're variable rate products. Mortgages are often variable rate. But the difference with a home equity line or an unsecured line is every time the bank changes the rate, you are automatically hit. Your payment changes automatically. And on home equity lines of credit, people are carrying really large balances. Like I'm not doing a $3,000 home equity line. I'm doing a $75,000 balance on my home equity line. So what we saw was this big swing in their payment. And this chart on the other side is actually tracking their ability to pay off their credit card in full. If anyone's heard me talk, I think actually Whistler in 22, and the same chart, I think. But basically what's happening is if I have a home equity line with a balance of $50,000 or more, I have a call to make. And the call I'm making is, I'm not gonna pay my credit card in full anymore. When you think of who that typically is, older, higher net worth, higher income, property in terms of equity, those are the people who are got a cash flow constraint that says, I need to make a decision point. I'm willing to pay 20% interest on my credit card to make sure I'm making my home equity line payment. So you're starting to see that strain on people that isn't in the headline number. You won't see this in the headline number, but you will start to see this in your portfolios as you manage through. But this idea of what we call transactor rate on credit card is a great indicator of that sort of cash flow. When that starts to go down, it tells you cash flow constraints are hitting. And we're definitely seeing that for people, anyone who's sensitive to those balances, we're starting to see that movement. The one that I think that was the most interesting thing we saw about a year ago, and it's continued, is everyone thought, oh my goodness, higher interest rates are going to hit mortgage holders the worst. That has not been the case. The reality is the non-mortgage people, I can't buy a house, I'm renting, I live in my parents' basement, whatever that is, they're the ones who actually felt the weight of the cost of living. Forget about interest rates, just the cost of living. So the likelihood of them being delinquent has been rising steadily kind of as we've come out of COVID. Mortgages are coming up, they're turning up, but they're still not as sharp. We started to see that narrow a little bit a while back, but even that has kind of leveled out. And so we saw that kind of swinging happen. And so again, it's this idea of cash flow. It's the person in non-mortgage who's now paying much, much higher prices for food and groceries. And it's great that the inflation rate's lower, right? I think food inflation's down to 1.7, but the reality is you're not going to take back the 28% that I've suffered for the last 3 years. And the thing is, if you get into a situation where those prices start to come down, now you're in a deflation cycle, which actually is worse than inflation. So you this is where we are, people. Your grocery prices, we can protest Galen Weston all we want. He's going to show up in a nice sweater because frankly his prices won't change. And he can't, that's how the market's going to work. So that non-mortgage group has really felt the impact much more than mortgage holders, who will start to feel that more. Like I said, the real big swing in renewals that are going to be at risk are still coming. So that's going to close. And we can see that kind of on the bankruptcy as well. Again, non-mortgage people. We'll talk a little bit more about sort of bankruptcy in a minute, but where we're really seeing that swing is this notion of consumer proposal, which is great for auto. Your car name is typically not covered by a consumer proposal. But again, if I'm not mortgaged, then I don't have a house to protect. And so those are the people who are turning these proposals where I've hit a tipping point. And a lot of what we've seen from them is, I've never missed a debt payment in my life. My utilization is not that high, but I just hit a point where it can't get better from here, so I'm just going to do the proposal and kind of get it under control. So again, that's been a big surprise, is the non-mortgage population really performing differently. And so if we look at from overall delinquency rates, they are returning back. Sort of the left is the non-mortgage, so we're kind of back to pre-COVID levels again, which weren't unreasonable. So I think the big ramp up we expected, and we saw a bit of a ramp up fairly early, and it sort of hasn't been as bad as we thought, so that's coming back. But again, mortgages, which has got a lot of the attention and focus, are still nowhere near actually pre-COVID levels. So yes, they're rising, but they're rising at a relatively slow rate. So we've really seen, again, this idea of there's groups of people. High income people with mortgages are actually doing really, really well. And then you got a big population that's probably around 60% plus of the market that really are strained. And it's not like they're in big trouble, but their ability to grow and do more is going to be a lot more limited than what they could do before. So overall, where's that kind of non-mortgage delinquency coming from? Auto's back to about where they were pre-COVID. Again, not surprisingly, after that happens, auto rises sort of a little faster than everybody else, but it's really sort of moderated. The HELOC's a very low number, so it doesn't look really high, but from a HELOC perspective, it has really accelerated. So that it's kind of more than doubled in the last year. Very, very low rate, but moving very quickly. The only one that's still well behind where they were pre-COVID is cards, but a lot of that is just the growth. And the one sort of misconception is that, while I showed you a lot of it was still at very low score, because a lot of it was new to credit, and particularly new immigrants who generally performed very well long term, that hasn't flowed through. The risk for cards is when your balance growth starts to slow down, because they've had such new acquisition growth, that will wash over. So that we expect, once balances sort of moderate, that will really start to rise up fairly quickly. So I talked about this proposal, sort of bankruptcy. So bankruptcy has been relatively mild. Like bankruptcies have been relatively stable for a while now. I think everyone expected them to really explode again, particularly I can't deal with my mortgage renewal, what do I do here? But because a lot of the renewals really didn't have the same level of change in the interest rate, as we will see, it's been pretty stable. But consumer proposals have really, really accelerated. You know, and I think for a lot of, some people might not really know proposals. I always refer to it as those U.S. commercials that late at night, that it's the credit card, it's the secret credit card companies don't want you to know, right? I go to bankruptcy trustees, say, hey, can we negotiate? They'll go to your bank, your credit card company, and go, I'll give you 30 cents on the dollar. And so we've seen this before. So pre-COVID, we had the same trend, where there was no signals, no delinquencies, they weren't overutilized. They just showed up one day with a proposal. And so we've started to see that again the last little while. And it's generally pretty consistent nationwide, particularly in Ontario, BC. Alberta's the one where they've had a strong market, again, particularly with a lot of that in-migration that they've seen. We haven't seen the same rise, although typically Alberta is generally higher from a bankruptcy perspective, and particularly bankruptcy versus proposal. And so they've sort of weathered through a little bit better than the other markets. So what does that mean? It doesn't from a credit card, so if you're thinking sort of broader from a risk perspective, we have seen a sort of steady decline in credit scores. Not overwhelming. Really, it's coming from the high end into like sort of the super prime to prime range. It's not really driving into deep subprime. So we've seen a bit of adjustment. I think we all expected it through COVID. We did see a bit of an increase. So it's sort of coming back to more normalized levels, but again, not really into deep subprime. We're still sort of where we used to be. But we are starting to see, so the one on the right is actually the percentage of people who've had at least a 5-point increase in the last year of their score. You're starting to see that rise a little bit. Ontario, BC, and Ontario in particular is where we are seeing a little bit more weakening. Like their credit card delinquency rates are not performing as well. And so Ontario, we're starting to see a little bit more strain than we are in BC. But we are seeing fairly big increases in both where people's score are starting to decline, just given some of the challenges that they're facing. It has been my voice the whole time. You know that, right? So anybody who wants to chime in, feel free. So, I mean, I'm going to talk to you a market that you know much, much more about than I do. In terms of the auto market, I think the one thing that we've seen is that the growth has been slower than we expected. I think you all would have done the same thing. I think we all expected a bunch of pent-up demand that we kind of pushed through. We started to see leases come back a little bit, probably not where they were before, but sort of bouncing back off those really low levels. I think the one area that we've been watching is just the average loan amount, and so that's generally leveled out. We saw a fairly good increase. Leasing in particular, and I think it's just how the market bifurcated once demand was down. But we've seen leases sort of moderating as well. That might just be a bit of a choice in terms of a product, where you're not going to as premium as you had before. Could have been some of the supply chain issues at the top end. But we are starting to see these coming back. From a risk perspective, actually, in general, we're actually seeing auto sort of buck the trend. Particularly on the loan side, actually, credit scores have been rising generally for new loans in the auto space. Again, this is primarily the auto finance space. So again, relatively consistent, if not slightly better from a risk perspective than we were seeing earlier on. Leasing super stable, again, very, very concentrated in subprime. We haven't seen that shift. We thought we might have seen a bit more of a shift as people were using leasing from an affordability perspective, but I don't think it's sort of played out the way we thought it would. But again, relatively stable marketplace from that perspective. What it does mean though is portfolios are adjusting. So, given that leases haven't been growing, they've been, the price point's been a little bit lower, sort of lease balances have been down way down. Loans are up quite strong, which means just your balance in the market. So where you had a lot of super prime lease in your portfolio, if you have both, you may see your portfolio shift down. It's more about product mix than an individual product line. And again, we are still seeing good growth in deep subprime and subprime. A lot of that's just, again, due to credit coming in, not necessarily all super high risk, because a lot of them will be new immigrants just building up their credit score, and we haven't really seen that flow through. But in general, that hasn't been a huge shift from what we saw pre-COVID. So from an auto perspective, relatively stable. I just think the growth rate was probably lower than we expected. Again, from a delinquency perspective, we've seen very little movement in leases. Lease delinquency has been relatively stable. We have seen it in loans again. So if you see your overall portfolio, if you're not splitting out lease and loan, it may look like you're rising, but a lot of it's just that mix issue. The one thing that we have been tracking is kind of the vintage. We have sort of seen that kind of COVID, sort of early COVID period through. We're seeing those vintages have deteriorated, particularly in the lower score groups. You know, the very high scores, not surprisingly, have been really, really consistent. But that's where we're again seeing that separation of high income, high wealth. Really, really doing well. It's the time, best time in their lives probably. But you're seeing kind of that marginal group, riskier groups, seeing that much more bigger flow. And we've really seen that sort of consistently right through vintage for the last couple of years. So the last one, and this is sort of model work that we've done, is new versus used. And so, you know, I think we finally saw new coming back, it's sort of stabilized, so the market seems relatively stable from the two. You know, I think the good news for ours is sort of used prices really stabilized. We had concerns, I know probably in 22 when we talked about this, around LTV on used books. We saw that was relatively high. Yet high LTV with extended terms is kind of a really worrisome thing. I think fortunately we haven't seen delinquency and losses accelerate the way we did before. But that stability is really, I think, good longer term for portfolios. Not necessarily great for growth, but in terms of risk is a little bit better. This is on the used side. So again, we haven't seen much deterioration at all. So actually, we've seen even sort of high scores using sort of used just as much. That growth has been good. So again, we did sort of expect to see a bit more of a shift back out of, you know, high scores going back to new. I think the fact that prices or interest rates haven't adjusted as quickly, they're just looking at affordable options, which tends to be used, and so that's been relatively stable. LTV a little bit higher. What we saw in volume in the last quarter versus last year, not too surprising again. It's really an affordability question about things. You know, from a user perspective, we have seen a bit of an increase in price over the last little while. Not too surprising, but I think people tried to hold off for a while, but we've seen that particularly early this year. A little bit higher rates. Hopefully, as Bank of Canada makes their adjustments, we'll be able to kind of get back to normal, more subvention, particularly on the new side. But again, even amortization. So this is about affordability. We are seeing that a large population, even though they're very good credit risk, know that sort of that ability to handle more is limited. And if I know that I've got a big mortgage renewal coming in a year, they're really going to have to factor that in because they are going to see much more significant impact. On the new side, again, relatively stable risk. We have not seen any deterioration despite the fact that overall we've seen some of that. You know, I think loan to value has been consistent. So new in particular, we've seen just much more consistent behavior across the board. Again, pricing is what it is. It's been stable for a while. You know, we are hearing talk, and you guys are probably seeing a little bit more subvention coming into the marketplace just to drive growth. It's just, don't think it's returning quite the way that they thought it was going to do. But even amortization has been consistent. And so again, new is just sort of the last 18 months is just hit a nice consistent path. In terms of portfolio, again, where you're going to start to see is a mix issue. So your new used mix is really going to change. New has come back, but the growth hasn't really come from a balance perspective. So sort of the new balances are just sort of offsetting the lost balances that are paying out. And average balances have really been sort of growing relatively slow on both sides and relatively consistent. We'll probably likely stay that way until we see a bit more of an either an acceleration in growth or an acceleration in the price points. Again, from the delinquency perspective, we have seen an upswing in used. Again, new's just been very, very consistent. Like there's almost no story about new. It's just plugging along, it's doing fine. But we have seen used going up. The bar chart is just used vehicles, so again, pretty much national. We're seeing the same thing. Quebec, again, as a market, if you remember I said earlier, Quebec didn't get that inflow of migration, either interprovincial or international, to the same level. So their economy, and sort of if you look at their job market, is not been as strong as the national numbers, and so you're kind of seeing that in that used delinquency bucket. But it is up everywhere. But again, it's generally a little bit above where we were pre-COVID, which was not a level that I think anyone was particularly alarmed about. So a couple of sort of key takeaways. I do think understanding your portfolio and segmentation is going to be increasingly important for the next little while. Like I said, this is not a uniform market right now. You have 20% who are doing incredibly well. You have sort of probably another 20, maybe 30% who are doing okay, they're holding on. And you've probably got about 40 or 50% who are really kind of at the end. There's, 20 of those, they're gone, they're going to be in trouble. But so you've got this market that's spread out. It's generally going to be very linked to income, but not always. And understanding kind of those other stress points. So if you've got someone who's got a high home equity line balance on there, the good news is that it won't get worse from here, but it's going to be slowly getting better. So understanding that cash flow capability, what do they have available, becomes really important. And sort of as you think about risk-based pricing and strategies, really important. The other one is around growth. Like I said, I think we all expected growth to accelerate, and it's gotten better, but not kind of the level we thought. So it's going to be about finding those good deals. It's about really great relationships with dealerships that are going to get you the best paper you can. The one area that we're paying a lot of attention to is payouts, though. So one of the concerns is interest rates get better. How quickly are people going to pay out their existing loan? So is it going to be much better for me in 9 months to go to an unsecured line of credit, or a home equity line for that matter, and pay out my 8.9 or 10.9% car loan? So sort of balances you were counting on a good interest rate may wash out much quicker. So we spend a lot of time sort of modeling and got an auto early payout model because we think sort of protecting those balances will become increasingly important. And the last one is really understanding this new to market, new Canadian, new to credit, young people. It is not going to go away anytime soon. I think you've heard slowdown in immigration numbers, but it's been very, very targeted primarily to international students, probably temporary workers, who weren't really the big, huge drivers of a lot of these numbers. So yes, as a number of people they were, but people who were doing more economically were really coming from others. And so being able to find that group and really model them really well. The other thing that will be interesting is how regulators will now start to pay attention to the auto market. It's happening in mortgages in a big way. Mortgage brokers are now going to have to do money laundering tasks. You are going to start to see the regulator coming into this space in ways they have not before. And I think a lot of people were like, well, I don't think auto is where money laundering is happening. Money laundering is happening everywhere. We have a fraud consortium. I can tell you fraud rates on auto are going way up, well into sort of 25-30% right now. So people are coming in, doing things, getting access to a car, getting access to creating a credit. I talked to non-prime group a while ago. They said, well, we don't have a fraud issue. The reality is, you may not be the victim of a fraud problem. You could be the source of the fraud problem. Like I could use that with a low score on a synthetic ID, create a credit file, then goes on to allow me to do a bunch of other stuff. And so I do think the focus will be mortgage. I do think auto will become a regulatory focus probably in the next 12 to 18 months because there's going to be a lot of pressure on money laundering in particular and fraud to make sure that's controlled across the Canadian economy. We haven't really seen an applicant before. I wasn't going to wait till the end, but no one asked the questions. Questions?
Hi, Bill. I have a question about the last point there, alternative data sources for the institution companies, international credit bureaus, anything on that point you can share with us?
Sure. So the question was around kind of international credit files as a source of alternate data. I don't know if someone planted that for you, but we actually will be launching an international credit report. It will be in UAT at the end of this month, early next month. So we are partnering with our group in India first. We will have 14 LATAM countries kind of by September, and then we'll have kind of US, UK, and Australia kind of early next year. So that's just one example of that idea of alternate data. So how do I leverage what was happening to them in their home country? Equifax like we have a global sort of scope. So we'll bring those in, but it's just another example. We're spending a lot of our time on rental data. The federal government made an announcement, super typical of the federal government, where they made an announcement about rental data should be part of the credit score, which is great, but can you make people give us the rental data to put in the credit score? Because there's a bunch of reasons why it's really hard for, first off, lots of landlords have 1, 2, 3 units. And so we do think open banking opens the door for us in terms of getting access to utility data, rental data, kind of income sources. Because I know that as an industry, auto's looking more and more at income verification. We're spending a lot of our time there. Many of you would have heard of our workforce solutions business that sort of has access to payroll data, but not those alternate sources of data. And part of the interesting thing was not so much the auto sector, but when the federal government made the announcement a couple weeks ago about rental data, the first call we got was, oh my goodness, what's that's going to do your credit scores? We shouldn't allow that. And you're like, hold on, right? Like, step back for a second. So there's always an immediate response of like, this has got to be bad news for us. It's like, it doesn't. And there's steps that we can take. I've been here for Trust Science. They'll tell you, there's steps you can take to make sure. But there is massive volume of value in our ability to use these different sources of data. It's interesting that open banking hasn't really been as embedded into credit processing in the UK, for example. It's really morphed into affordability, but there's really an opportunity to do both and sort of just streamline it. So I know there's going to be a lot of talk about automation, and I know I'm on a panel tomorrow, we'll all talk about it more. That ability to just get that information is going to be incredibly important to this industry, where just things that would take a day or two is take seconds so you can get access to the right information.
Bill, we're talking about income verification here. I'm just curious, how does the gig economy impact that? If I'm thinking about a typical way these days for a new immigrant to get work, the gig economy is going to be a big driver of that. How does that play into some of this income verification challenges?
Yeah, so that's why a lot of what you've seen in the UK from an open banking perspective has gone into affordability and income. It gives you the ability to at least see the inflow into your bank account. Now that's net income, so you have to adjust a little bit to manage net income, but open banking and a lot of what you'll hear, Senator Colin Deacon is a big supporter here in Canada. It just will open up things like gig economy that today is really, really hard to get to. I mean, many of us are working with organizations like Intuit and sort of accounting software that might have some of that. But open banking will be a really important next step to really help us understand that gig economy and how the cash flow works. Lad said I can have as long as I want, so we'll keep going. It isn't, I love hearing people who don't agree with stuff. So.
Bill, my question is, are there any global macroeconomic tailwinds that may adversely impact what seems to be a steady improvement here domestically?
Yeah, so for people in here, it's sort of, is there any global kind of headwinds coming? I think there's a lot of instability. So I think right now, what you're seeing in kind of the Middle East, what you're seeing in the Ukraine, all of those things just create instability. Some of what the federal governments can do, some of what Bank of Canada or US Fed can do. So I'd say it's the political stability issue. There is a US election, coming up in November. That will have a fairly significant income impact. I think if you remember when Trump was in power last time, he really sort of went, hard against NAFTA and free trade and tried to isolate the US in terms of trade. So there's a bunch of things that will happen, but right now it's just about stability. Like if we can't get to a point where we can sort of go back to globalization. So the funniest thing was, we went into mass globalization, kind of COVID came along with these supply chain issues. We've seen a whole bunch of issues sort of politically. So we're sort of kind of back into, insular markets again. But we've been built globally now, so it's going to be very hard. And I think if we can't keep those flows going, that's where you're going to start to see supply chain issues again. If you start to sort of cut off trade routes, I mean, you're seeing it already kind of in the Red Sea. Those are things that will drive prices again. And so Bank of Canada will be very reluctant to move if they think supply problems are on its way. The reality is they can't control it, so maybe they shouldn't worry about it so much. But it is the political instability right now that's the one that has probably the biggest X factor around our ability to grow. And in Canada, it's really about the immigration component. If we change that program, if we slow it down, we will see a deceleration in our growth. Unless we can do something to really drive the domestic market again, which would be much, much lower interest rates. So it's going to take a while. I'm around. If anyone has questions, feel free. Thanks.